Benefits of investing in equity, liquid and debt instruments. Equity investment generally refers to the buying and holding of shares of a company by individuals and firms in anticipation of income from dividend and capital gains due to a rise in the value of the company. Amongst the various investment options, equities may be highly rewarding, but then the risks are equally high. Investing in equity is like owning a small part of a business. For example, businessman A wants to start a business, but he needs capital of ₹100 to invest in the material, the labor, a retail outlet and marketing. Investor A gives him ₹100 for 50% of the business. As businessman A's business expands over the years, investor A's ₹100 could multiply as the value of the business increases. Investor A may also receive dividends from the profits that are not plowed back into the business. However, if businessman A's business does not take off, investor A may lose some or all of his capital investment. Equity mutual funds help an individual to reduce the risk of investing directly in equity for several reasons. Fund managers are professionals who have more knowledge of the markets than an average investor does, and, therefore, their performance is likely to beat that of an average investor. Fund managers are trained to be greedy when others are fearful, and fearful when others are greedy. Therefore, they are more inclined than average investors to cut losses when stocks do not perform well, and to add to their stock portfolio when others are selling and prices are coming down. Most importantly, since equity mutual funds are diversified, the risk is spread over several stocks. Debt instruments allow the borrower to raise funds at a particular interest rate over a fixed period of time. Types of debt instruments include notes, bonds, mortgages, leases, or other agreements between a lender and a borrower. So, if you invest in a debt instrument, your capital is protected and you know in advance what your investment will be worth over the time period that you stay invested. There is little risk. At the same time, the upside is also limited or almost nil. Debt instruments are suitable for those who have limited risk-taking ability, but at the same time would like to earn more interest on their capital than they would by parking their money in financial institutions. Debt mutual funds are one of the avenues through which to invest in debt instruments. Your capital is protected because the types of bonds that fund managers choose to buy usually have high ratings. The risk is therefore low and the return is moderate. Mutual funds are the most tax-effective form of debt investment as compared to other debt instruments. A liquid asset is an asset that can be converted into cash quickly. Liquid assets include most money market instruments and government bonds. A liquid asset is suitable for those who need liquidity and would also like to earn interest on their funds while they are not being utilized. In fact, for liquid mutual funds, interest is payable even on bank holidays. A liquid fund usually gives a higher rate of return than investments in other comparable asset classes, and the return is tax efficient. In case you would like to have exposure to all the three types of investments mentioned earlier, a balanced fund could be the answer. A balanced fund usually has a stock component, a bond component, and a money market one. Balanced funds are preferable for investors who are looking for a mix of safety, income, and some capital appreciation. Balanced funds may have a high equity component for investors more inclined towards capital appreciation and with some risk appetite, or they may have a high debt component for investors more interested in income and security. Balanced funds are advisable for people with a long-term investment horizon. Your independent financial advisor can help you decide on the instruments best suited for you, given your needs and risk profile. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.